Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. What is the value of a U.S. dollar? And how does that compare with other currencies? Are we headed for disaster, or is the dollar actually getting stronger? If you're a real estate investor, the answer matters to you. So today we'll discuss the future strength of the U.S. dollar, and we've got a great guest on the Real Estate Guys radio program.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me, it is our co-host financial strategist, Russell Gray.
Hey, Robert.
If you buy real estate, no matter where in the world you buy real estate, you're likely to pay in U.S. dollars. Now, that's surprising to some folks because in many of the countries we go to, there is a local currency, but the real estate still transacts in U.S. dollars. And so real estate investors ought to be concerned with the health and future of the U.S. dollar. And so today we're going to talk less about real estate and more about where the dollar is headed, because there are a lot of folks who think it's headed off a cliff.
Well, I think it's really important for Americans in particular to learn to be bilingual when it comes to currencies. We've been advocating for a long time people paying attention to the U.S. dollar in context or in comparison to gold, which is a great barometer for the health of the dollar. It's like home base when you were a kid. You played tag and you had to go someplace where you could pivot and go anywhere. And that's kind of what gold is. It's always got a bid on it in any currency. Over the last couple years, central banks, which are the printers of paper currencies, have been loading up on gold. They changed the rules and made gold a tier 1 asset. And so that's part of what's driving that. There's also this big global move to de-dollarize. And Americans, especially real estate investors, don't really pay any attention to all of that. I think we've done a pretty good job leading the charge for real estate investors to pay attention to the Fed and who prints the U.S. dollar and monetary policy, which affects the bond markets and ultimately interest rates. And if you make the leap from mortgages and interest rates to the Fed and monetary policy, the next level up is to really understand currencies. And so we've been spending more time hanging out with people who really pay attention to these things. And I can tell you there's a mixed consensus. In other words, everybody believes that fiat currencies in the long term are in trouble. It's not the trend anybody argues about, it's the timing. And then, of course, what you do to prepare. So we're going to take a deeper dive into that today, and it's going to be a great, great conversation.
Now, already you're thinking, wow, this is some heady stuff. I am not sure this has anything to do with my rental property. Well, it has a ton to do with it. And I think our guest does an excellent job of explaining some pretty complex ideas in a way that we can all understand. We first met Brent Johnson several years back, and he's just a nice guy, but well-researched. He has a theory. And he's going to share his theory with us today, but I think it'll help you get your mind around what the dollar really is doing and where it fits in the global economic system. When we come back, you'll meet our friend Brent Johnson today on the Real Estate Guys radio program.
Hi, I'm Mark Victor Hans. You're listening to the Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Now in its 27th year of broadcast, there's a ton going on in the world, and there's some concerns people have, and I think our guest today is equally concerned, but he's got maybe a little different perspective than some. We were first introduced to Brent Johnson a few years ago by our good friend George Gammon. We've seen him at the New Orleans Investment Conference several times, and more recently at the Collective Inner Circle event in the Bahamas. Please welcome to the Real Estate Guys radio program, Mr. Brent Johnson. Hey, Brent.
Hey, thanks for having me.
Hey, it's great to have you with us, and we've got to spend some time together recently. And, I think there's a couple things that real estate investors need to understand, that they are not always clued in to the macroeconomic picture. You spend a lot of your time in the macroeconomics because, of course, you help clients create and sustain their wealth, and that's important to understand these things. But there's two major concerns that I think maybe your work can help us address. One is people have heard for years that all fiat currencies go to zero. So eventually our dollar will be completely gone, and that worries people. And then you hear all this talk about de-dollarization, the BRICS, they're going to have an alternative currency. So I know real estate investors get uneasy about that talk. Now, you have been studying this for quite a while. In fact, anyone who knows your work probably knows about your dollar milkshake theory. Before we get into that, if you would, give us just a little bit about your background. How did you get in all of this macro stuff and into managing money for clients?
Yeah, so I guess if we go way back, I grew up in a little town in Nebraska, very, altruistic, prototypical American childhood, like a Norman Rockwell painting. Nobody locked their doors, and you in the summer you left at 8 a.m. and you came home at 9, and your mom didn't know where you were the whole day, and she didn't really worry about you either. And, we had a 4th of July parade. And so I kind of, and that was kind of back during the 80s, the 70s and the 80s. And, the U.S. was kind of at its zenith at that time period. And so that's kind of when I grew up. And, even though I grew up in a little tiny town, for some reason that I still don't quite understand, and my parents could never figure out, is I wanted to live in a big city. And I wanted to work on Wall Street, even though I didn't even know what Wall Street was. My parents didn't have brokerage accounts, and my dad wasn't a huge investor or anything. But for some reason, that's what I wanted to do. So through some hard work and good fortune, that's where I ended up.
Well, and it's pretty interesting. Everybody starts with what they have and where they're at. But I think obviously building some of those long-term values is important. And then when you get into the machinations of the economic world, there's just so much you have to learn. And frankly, the last couple of presentations we've had you do have really helped illuminate, I think, for a lot of our members and folks, a lot of this. And people don't see the whole picture. I think that's part of it. Take us through, if you would, the dollar milkshake theory.
Sure. It's interesting that you reference kind of where I grew up and those values. And to be honest, that's part of the reason that I've pounded the table as hard as I have on this. And it's kind of the reason I came up with the analogy of the dollar milkshake to begin with, is because there's a lot of people I talk to who work very hard, who are very smart, but they weren't educated about currencies or monetary policy, and they don't know the financial jargon or the lingo. And it's very easy to get confused in all this stuff. And I think a lot of times when people start hearing these types of words, they just immediately shut down because they don't understand it. So I had to come up, or I wanted to come up with a way to kind of explain these kind of complex issues that I think the world is going to deal with in a somewhat simplified manner that, kind of the everyday person could understand. So the dollar milkshake, it essentially comes from the fact that, if we go back 15 years, and we could probably go back further than that, but if we go back 15 years to the global financial crisis, I think most people around today kind of remember that, and what a crazy time that was. And I think a lot of people, even if they don't understand the mechanics, they know that there's been a lot of bailouts, or there's been a lot of printing of money, there's been a lot of government stimulus since that time. And that has led to this belief that the dollar is going to get inflated away, and that you need to get out of the dollar. You need to buy either real assets or gold or some kind of, maybe even go to alternative currencies, because this is just unsustainable. And this is all going to end up in hyperinflation of the US dollar and the collapse of the US economy. And my issue is this: is the people that come to this conclusion, it's not so much that they're wrong in their analysis. It's just that their analysis is incomplete, in my opinion. I think if you were to analyze the United States in isolation, that's a pretty good conclusion to come to.
Yeah.
We have made many, many mistakes as a country. We have not lived within our means. There has been, an incredible amount of money created. There's been an incredible amount of stimulus. Government programs have saved people who probably didn't deserve it and punished others who don't deserve it. And so from an emotional standpoint, I understand how the people come to this conclusion. And the issue, though, is that it's a very big world. As much as we may like to just analyze the United States in isolation, if you do that, you miss a huge piece of the puzzle. Without going into too much detail, the rest of the puzzle looks even worse than the United States.
Right.
In other words, if you were to do the same deep dive analysis on the United Kingdom or Europe as a whole, or Japan, or China, or Russia, or India, or South Africa, or Brazil, you do this same kind of deep dive economic analysis on these other countries, and you give them the same level of critique, I guess, that you do to the United States, and you look at their politicians the same way you look at our politicians, and you realize that they've got enormous problems as well, and in my opinion, bigger problems than the United States does. And then you also realize that, for better or worse, maybe it's deserved, maybe it isn't, the United States has a number of advantages that the rest of the world just doesn't have. And as a result of that, money has to go somewhere. As an individual, perhaps you have the opportunity to just cash out, put all your money under your mattress, and just wait it all out.
Yeah.
But big global asset allocators, big pension funds, big endowments, big mutual fund companies, pension plans, central banks, they don't have that option. They can't just take everything out and put it under the mattress and come back in 10 years. And that money, the global capital will flow to where it's best treated. Now, it doesn't mean it has to be treated well. It just has to be treated better than everywhere else.
Right.
And so it becomes a relative game. And currencies, ever since 1972, when they took the United States dollar off the gold standard, currencies don't trade on an absolute value to something tangible. They trade relative to each other. And when you start realizing that these other countries have these same problems and perhaps even bigger problems, and they don't have near the number of advantages, and then when you realize that in many ways the game is rigged, just as a very simplified way of saying it, in the United States' favor, the dollar on a relative basis starts to look much better than these other currencies. Not to mention, and this is where it starts to get a little bit more confusing, I'll try to simplify it, is when the United States did take the US dollar off the gold standard back in the 70s, very shortly thereafter, they convinced Saudi Arabia to sell oil in dollars only. And because the whole world needs energy to run their economies, the whole world needs oil. And so the fact that oil was only priced in US dollars meant there was an underlying demand for the dollar. And that led to kind of a turbocharging growth of what's called the euro dollar market. Some people refer to it as the petrodollar. This is a very long way of saying that the dollar market outside the United States is even bigger than the dollar market inside the United States.
So let me stop you there for a minute, because this is one of those head explode moments that I would say the average person has no idea exists.
That's right.
And people remember the petrodollar and all of that negotiation, and now the fact that, if France wants to buy oil from Russia, they have to do it in dollars, creates this demand for dollars. But if we wanted to get really wonky, or ask our friend George to teach us how dollars are created, it's not just the dollars and the supply of money, we'll call it currency, actually, in the U.S. There are tons of quote-unquote dollars that are completely outside the U.S. system.
That's absolutely right. And again, the market and the demand for dollars outside the United States is much bigger the demand and market for dollars inside the United States. Sometimes you will hear this referred to as the euro dollar market.
Yep.
And it gets a little confusing because then people think they're talking about the euro currency. It's not. It's the market for dollars outside the United States.
Because trade has to happen in dollars. There has to be some equivalent.
Yeah.
I mean, two countries can always get together and decide to sell each other products in their currency. But what do you do with that currency? The dollar has, like it or not, been proven to be the world's reserve currency, which creates this demand for dollars that otherwise wouldn't be there.
That's absolutely right. And another way to think of it is let's pretend that you speak Spanish. You're an American, but you speak Spanish.
See.
And you travel to France and you meet a French person that you want to talk to. And the French person speaks English and French, but doesn't speak Spanish. So you could either learn French or they could learn Spanish, or you guys could just talk to each other in English.
Right.
And because most people speak English, or because English is the most widely used language, that has become the business language of the world. You can kind of think of the dollars as the same way. It just simplifies it for when India does business with South Africa, it just kind of makes it easy rather than the South Africans learning Hindi. It makes it easy just to do business in English. And again, maybe you think this is appropriate, maybe you don't. I'm just telling you this is the way it is.
Yeah.
Over the last 50 years, since this petrodollar or the US dollar pricing of oil in dollars, it's led to an explosion growth of this euro dollar market, and it's led to an explosion of the rest of the world borrowing in dollars. So there's an incredible amount of US dollar debt owed by people outside the United States. And they don't owe that money to the United States. They owe that to other people outside the United States.
Yep.
But this is why when you hear this idea that there's going to be de-dollarization is the same thing as deleveraging. Because in order to move on to something else, they first have to pay off all that US dollar debt.
Yep.
If they don't pay off all that US dollar debt, if they just default on it, again, they're not defaulting on the United States, they're defaulting on each other. And so there would be major consequences if they decided not to pay back this US dollar debt. Somebody would no longer have to pay that debt, but somebody's asset would disappear as well. That would create all kinds of problems. That would be 2008 on a global scale.
Yeah.
This is why when I hear these things about de-dollarization, the US is going to lose the global reserve currency, they're going to print all this money. It's not that they're technically wrong. It's just the magnitude that would have to happen in order for that to take place is so much larger than the average person understands. And maybe this analogy will help. Let's pretend, I think a lot of times, if you had a swimming pool and it was full of water, and then the government came in and they put a big faucet above the swimming pool and started pouring more water into the swimming pool, the swimming pool would overflow and all that excess water sloshing around in the streets and on the lawn, that would be inflation.
Yep.
That would be the dollar losing value. And they do that. They do come in and they do put water in the pool. But the reason they put the water in the pool in the first place is there's a hole in the bottom and all the current water is leaking out. They don't just come in out of the blue and decide to put more water in. They put more water in because if they don't, that swimming pool is going to end up empty. And as it drains out the bottom of that pool, it goes into another big pool below it, which is 10 times bigger than that swimming pool. And that's the euro dollar market. So for them to print enough to overflow the pool, it's not that they can't do it. It's just that it's just much harder to do than people realize. And this is where it gets complicated again. I'm trying to make it simple, but the other countries have to do the same thing with their local currencies. So Europe has to print more euros.
Yeah.
And Japan has to print more yen, and China has to print more yuan, and Brazil has to print more real. And they don't have that sub pool below the regular pool. So it's much easier for those other swimming pools to overflow, whereas our swimming pool, the United States swimming pool, has a drain in the bottom that it goes into. And so for all of these reasons, it's not that I don't think that we're going to have problems. It's not that I don't think a crisis is possible. I think a crisis is actually likely. I just don't think that it ends with the US dollar going to be worthless and into hyperinflation. I think it probably goes the opposite way, because when everybody has to do the same thing, but there's more demand for dollars, the dollar actually rises on a relative basis versus other currencies. Now, the reason this is important for things other than if you're a currency trader is that most things in the world are priced in dollars.
Yep.
And so if the dollar starts to go up, if the denominator starts to go up, the numerator typically starts to go down. Not always, but typically that's what happens. And so when that happens, especially overseas, maybe not to the same degree in the United States, but especially overseas. And when that starts to happen, defaults start to happen.
Yeah.
And when defaults start to happen, that's when you get a chain reaction that leads to money disappearing. So think of it this way. If you look at a long-term chart of just about any asset, it goes up and to the right.
Yep.
And fiat currency, paper currency, loses value over time. That's part of the reason these charts go up and to the right. And that's why investing in stocks and real estate and perhaps precious metals or artwork goes up over long periods of time. However, you can have these very significant and painful drawdowns along the way.
Yep.
Such as 2000, such as 2008, such as 2020. And so it's not easy just because if you knew currency was going to lose value and assets went up and to the right, all you would do is take out a bunch of debt, hold on to that asset, and as it appreciates and the currency loses value, you make a bunch of money.
Yep.
And over long periods of time, that typically is what happens. However, if you're over leveraged and that happens in the middle of one of these severe drawdowns, maybe the severe drawdown only lasts 3 months, maybe it lasts a year. But if you are over leveraged during that time, you may end up being a distressed seller rather than a distressed buyer. And so even though you know that over time assets go up and to the right and fiat currency loses value, there can be these pockets which can create all kinds of chaos. And I don't think it's wise to just ignore that possibility because, again, you don't want to become a distressed seller.
All right. Good stuff. Hard to get your mind around, but I knew you could clarify it for us. One of the things that we've been watching for more than 10 years is various countries who understand most of what you just said, but are still not happy necessarily with the monetary policy of the U.S. and have decided, well, maybe we could, trade together. And we've heard about, Russia making a direct trade with China and so forth. Can you speak to that and how little impact it actually has?
Sure. So let me take one step back. Because the whole world uses dollars, to a certain extent, the whole world is dependent upon U.S. monetary policy.
Yeah.
The United States wants to make a lot of dollars available through easy monetary policy. That makes it easy for the world. If the U.S. government wants to make the dollar stronger or slow down economic activity or have tight monetary policy and make dollars less available, that's hard for the rest of the world. And to a certain extent, the U.S. can export their inflationary pressures to other countries. Other countries obviously don't like this. Everybody likes to be in control, especially the president of their own country, right? A president or a monetary authority of their own country wants to kind of feel like they're the major player in that economy. The last thing they want is a foreign power telling them what to do.
Sure.
But that's kind of what happens in this relationship. And so, not surprisingly, the rest of the world is kind of tired of it. They don't like it, right? And they're trying to get out from underneath it. So they're trying to de-dollarize. They're trying to set up these trade deals outside the dollar. And I don't deny that this is being attempted. I just don't think that the success level is anywhere close to what is advertised. And I think to successfully de-dollarize means to successfully deleverage. And I've never seen a deleveraging that didn't include a lot of pain and volatility. When you read these headlines, Russia and China are now trading together in their local currencies, or India and Russia are trading together in local currencies. I'm not saying it's not happening. It just doesn't mean that the United States is going to lose the global reserve currency overnight. There has literally, I can remember being 10, 12 years old, early to mid 80s, reading newsletters that my dad had talking about the end of the dollar. That's 40 years ago, right?
Right.
And so people say it's just a matter of time. Yeah, it's just a matter of time, but it could be another 30 years. And you have to live today. You have to manage your business tomorrow. You have to pay your bills next week. And so it's important, while you know the end game, it's important to kind of have an understanding of the path. These other countries, when they start trading with each other, it's not that they can't do it. It's just that, as an example, Russia sold $30 billion worth of oil to India. Russia let India pay in rupees. Now Russia has 30 billion in rupees that they can't use because they don't want to buy $30 billion worth of stuff
from India.
Now they're trying to figure out, the market always figures something out. It's not that it can't be done. It's just that it's so much more quick and efficient and cheap to do it in dollars. And not only that, but if everybody started trading outside of dollars, that means there's going to be less dollars circulating. But remember, all that debt, there's more US dollar debt outside the United States than inside the United States. So if the dollars aren't circulating, where are they going to get the dollars to then service that US dollar debt or pay off that US dollar debt?
Because they can't print dollars.
Because they can't print dollars. The only way they can print dollars is by extending a new loan. But when they extend a new loan, they're putting their own capital at risk.
Yeah.
The US can print dollars without putting its own capital at risk because it can just make them up out of thin air, right? So the US is the only one who can create dollars without putting their own capital at risk. And when the time that is new dollars are needed is when there's a credit contraction, which is the exact opposite of extending new loans. So you see the contradiction here is people say, well, they could just extend new loans. Well, yes, they could, but the reason they would need to extend new loans is because the current loans are contracting.
Yep.
The answer is correct, but functionally, to have it functionally happen, it just doesn't work that way. So, and even if it does, it just extends the problem. If they did extend new loans, it makes the problem bigger. This is a Gordian knot that, in my opinion, cannot be solved without chaos.
Yep.
And so the way I see it is either the system continues on as it is and the system continues to grow and ultimately the problem gets bigger and assets go up and to the right and we all, we buy houses and sell houses and we buy stocks and sell stocks and everything just kind of continues on as is. Or if we really do have this deleveraging or this de-dollarization, it's going to be very chaotic. You're not just going to wake up one day and the US is in a piling heap of ashes and the rest of the world is living great. That is not going to happen. And I would actually argue during the chaos, the US would be the preferred place to be because even though it will hurt us very badly, it will hurt everybody else even worse. That is the milkshake theory. And where I got the name, the milkshake theory, is there's a famous movie called There Will Be Blood, and there's this ruthless oil executive who's negotiating a piece of land with his neighbor. The neighbor wants to sell him the land, but ultimately the guy says, I don't really have to buy your land. I can just stick a straw down into the ground and I can drink up your oil. And he says, I'll drink your milkshake. That's where it comes from. And when the world gets into these problems, they typically print money. They flood the system with stimulus. That's mixing the milkshake. But again, for all of these several reasons, the US has the biggest straw.
Yep.
And so I think when that happens, the US kind of sucks up all that excess liquidity, pulls it into the United States. It somewhat insulates us. We still get hurt, but the rest of the world doesn't have any liquidity or is deprived of liquidity, and they go down more than we do. So I don't know how I got off on that long tangent, but that's kind of what it is.
It's the comparative analysis, right? Our mutual friend Peter Schiff always talks about the U.S. being the cleanest dirty shirt in the hamper.
Right.
And the reserve currency status, people are worried about that.
Right.
So much to think about. Our guest is macroeconomic thinker and fund manager Brent Johnson. We'll hear more from Brent, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
All aboard. Registration is open for the Real Estate Guys 22nd Annual Investor Summit. Imagine spending more than a week with like-minded investors, world-class educators, and real-world professionals. Returning in 2024 is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, and the rebel capitalist George Gammon. Back with us in 2024, sales legend and best-selling author Tom Hopkins. And joining us live and in person for his 12th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet, and a lot more. It all begins June 13th in Fort Lauderdale, Florida. Visit investorsummitatc.com to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to investorsummitatc.com and make plans to spend a week with the Real Estate Guys, Ken McElroy, Tom Hopkins, and an all-star faculty on the 22nd Annual Investors Summit at Sea.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Hi, I'm Robert Kiyosaki, and I encourage you to listen to those wild and crazy real estate guys. They're the best, been working for years, and they know what they're talking about.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you want more clarity in your life, if you want better results in 2024 than you had in 2023, and if you just want to be happier and healthier, come on out to our annual Goals Retreat. It's called Create Your Future. It takes place the second weekend of the new year. You're going to dig it. You get all the details at goalsretreat.com. That's goalsretreat.com. We're talking today about the future strength of the U.S. dollar and what that means for real estate investors. Before we get back to our interview with Brent Johnson, it's time to play Real Estate Trivia, your chance to win a prize by knowing the answer to today's real estate trivia question. In just a minute, I'll give you the question. As soon as you think you've got the right answer, send it to us via email at trivia@realestateguysradio.com, trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address, because the first person that gets it right gets this awesome book called The Warrior Ethos by Stephen Pressfield. It's a great book and a pretty quick read. That can be yours if you know today's real estate trivia question. Last week we had Mike Maloney with us, and we gave away a copy of his new book, The Great Gold and Silver Rush of the 21st Century. Here was our question: which country is the largest producer of silver? According to Statista, it's the country of Mexico. Silver is mined in a lot of places, but Mexico often tops the list. In 2021, Mexico accounted for over 24% of the world's silver production. Here's our real estate trivia question for this week. Last week it was gold and silver. This week, money and currency. Here's what we want to know. In what year was the first paper currency in the U.S. born? Yeah, prior to that, it was all coins and bartering. But in what year was the first U.S. paper currency born? If you know, send your best guess to trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address. The first person that gets it right gets The Warrior Ethos by Stephen Pressfield. That's today's real estate trivia question. We're talking with Brent Johnson about the future of the dollar and how it compares to other currencies. Brent, let's talk about the BRICS, because there's also been a lot of talk about just the population represented, the landmass represented, that these folks are getting together and they're meeting outside of the U.S. and they want their own currency, and it might be backed by gold. And how does that fit in?
Well, so again, the BRICS have they kind of sprang up in the late 2000s. I think 2009 is when they were founded. Basically, kind of a trade group that could kind of work together to try to de-dollarize, to try to get out from underneath this U.S. influence.
Yep.
And again, they control a big portion of the world's economy, big portion of the world's population. As a group, they're a formidable group. That said, there hasn't been much actual progress made on them cooperating and, doing it outside the influence of the U.S. dollar. They always talk about it, but when you actually look for concrete steps, they're pretty minimal. It's not that they don't exist. It's just, it's like if you have a house and, you say you're going to remodel the whole thing, and maybe you paint the basement, but you haven't actually remodeled the whole house, right? So I'm not saying they're not doing anything, but it's just, it's kind of insignificant to the overall problem. And not only that, this, like the problem we referenced earlier with Russia and India trading amongst each other, even if they do start to do it, it doesn't always go as smoothly as they think it's going to. And so, there's been a lot of talk over the last couple of years of the rise of the BRICS, the de-dollarization. They're going to launch this new currency. But, when we got into the 2008 crisis, a lot of times, if you trace it back, it was to these mortgage CDOs. And what they did is they had these really risky mortgage CDOs. But what they did is they put 300 of them into one fund. And they said, because there's so many of them, it's not really risky. Well, that's kind of what they're doing with the BRICS here. If you look at the individual currency of any of these, I mean, the Brazilian real's been done pretty good, but the Indian rupee's done horrible. The Chinese currency's done horrible. The ruble's done horrible. The South African rand has done horrible. So just because you're going to put all these currencies together, now all of a sudden it's going to make it a great currency. I just don't get it. Again, I understand the desire, and I understand the attempt, but when you're actually putting your capital on the line, your nest egg, your hard-earned money, I think you should look what's actually happening as opposed to like what you would like to see happen or what you think should happen. And instead just focus on what's actually going to happen. And I don't think that these other, these BRICS countries can match up against the United States, on these different factors. And again, that's why I say it's not that the U.S. is perfect. And I'm not an American exceptionalist. I don't think we're smarter than everybody else. I don't think we're the bright, shining city on the hill and everybody else is like in the valley. I just think that because of the way the world is, we have a number of advantages that they don't. And in a comparative analysis, we're the best neighborhood in a rough city. You know what I mean? And if you're going to buy a house in a city, you probably want to have it in a pretty decent neighborhood. And so that's kind of how I think of it.
Well, and one of the things you brought up when we were together last was the fact that in order for something like that to work, like the euro did, to have a currency between countries, there has to be kind of a level of trust. And how much trust is there really between those countries? And how much trust is there in, the full faith and credit of those currencies?
Well, I mean, again, you get historically, Russia and now they've been partnering together recently, no doubt about it. And it kind of goes back to the enemy of my enemy is my friend. They're kind of trying to, combat the efforts of the West. And so I wouldn't deny that there's cooperation, but historically, these are two regional, rivals. They're not historic partners. And India and China, I mean, they're huge rivals. Their soldiers are currently fighting each other on their border. So the idea that these 5 or 6 countries are all going to band together and work together seamlessly, and they're going to take on the United States and the Western economies, and it's an automatic victory for the BRICS. I think that's a little naive. And again, when people hear me say this, sometimes they'll think, well, those are really powerful countries. And again, they are. I'm not knocking the countries themselves. I'm just saying, if you're putting your actual money on the line, are you going to bet on the United States? Or are you going to bet on Brazil? Are you going to bet on India? Or are you going to bet on the United States? And because the idea that they can just walk into a room and all of a sudden agree on everything, despite being rivals, I think it's not likely. If you have any doubt about this, just think about Thanksgiving dinner this year. Everybody in that room is either your very good friend or your relative. And you guys are sitting there eating together. Do you guys all agree? If you guys were going to go watch a movie that night, could you get everybody to agree which movie you were going to go to and what time you were going to go and whose car you were going to take and what, who was going to buy the drinks? And just going to a movie becomes a difficult,
protracted negotiation.
Yeah, exactly. And so to think that all of a sudden now you're just going to launch this currency that everybody is going to use and everybody's going to trust, and people are going to be happy to now get paid in this new currency rather than dollars. It's not that it can't happen. It's just that it's a long shot at best.
Yeah, there's so much demand already for dollars inside and outside of the country. Real estate in most places is priced in U.S. dollars, even though the local currency might not be. So for real estate investors, we ought to feel at least somewhat better about being in the dollar. Let's switch gears for just a minute, if we can, since what you do when you're not educating folks and sharing these ideas as you help manage people's money. This is an interesting time to be thinking about that. Yeah. So how is it that you approach your wealth and how you maybe preserve it versus trying to grow it? Yeah. And I know you spend a lot of time looking at different metrics and hedging and all that. What are some maybe ideas you might share with us, Brent?
So as a general rule, I believe in diversification. Now, I happen to think that over the next, call it 5 years, I think the United States is going to be a preferable place to be invested rather than overseas.
Okay.
So when I say diversification, I'm not saying you shouldn't have any money outside the United States. I'm just saying I expect the U.S. to outperform the rest of the world, much like they have the last 5 years, despite the enormous problems. And, as I mentioned earlier, I manage capital over long periods of time. And so I think assets will go up and to the right. Sometimes because of market reasons, and sometimes because the governments will intervene and force it or print money or bail out entities, however you want to define that. And so I can't just sit in cash and wait for this big crash. There's been people who've been sitting on the sidelines since 2008, waiting for the next big crash.
Yep.
And they're still sitting on the sidelines, right? So we keep a diversified basket of assets. The equities we own are typically big blue chip US, companies like that pay a nice dividend. We have short-term fixed income because yields are pretty high right now. You can sit in a T-bill and get 5%. That's not horrible, right?
Right.
I mean, a couple of years ago, you had to buy a junk bond to get 5%.
Yep.
We have some exposure to commodities, but right now, most of the commodities we have are of the soft commodities, the wheat, corn, soybeans. We think food prices could go up dramatically over the next couple of years. We don't own really any industrial commodities right now. We do own gold. We think everybody should own gold, but that's kind of a long-term play. It doesn't necessarily think it's going to go to $5,000 tomorrow, but we think it's important from a portfolio perspective to own it. And so we have kind of a diversification of those 4 different assets. And all my clients have real estate.
Yeah.
So if you think cash or fixed income is one asset, equities are another, real estate's a third, and perhaps precious metals or some kind of collectibles or real assets is the fourth.
Yep.
So we have kind of those 4 core assets. And here's the thing is a lot of people don't realize this maybe, but if you just owned those 4 asset classes, 25% in each over the last 50 years, you would have only lost money like 5 or 6 times. And the most you ever would have lost was 13%.
Yeah.
Right. And you would have almost kept up with the S&P 500 over that same time period. So just doing that one simple thing kind of prepares you for everything, and your money goes up and to the right. So we kind of guide people towards that portfolio philosophy. And then what we do is we do like an option overlay on top of all of this that helps us profit in the short term if we get one of these very severe drawdowns, such as 2008 or 2020. And sometimes that optionality doesn't pay off, and it can be a slight drag on the portfolio, just like an insurance policy. People pay insurance for their cars or their houses. They don't necessarily want their house to burn down just because they have an insurance policy on it, right?
Right.
It's kind of the same concept there. We have found that over time that allows us to participate in markets that go up and to the right, but be prepared for these terrifying drawdowns along the way.
Brent Johnson is the principal at Santiago Capital and makes his way around lots of good conferences and podcasts. We sure appreciate you sharing with us today, Brent.
Thanks for having me.
Hey, if somebody wants to know more about your work or learn more about what you do, what's the best way for them to reach you?
Well, I'm pretty active on Twitter. If you type in Santiago Capital, I do a lot there. We have a podcast that we do every week called Milkshakes, Markets, and Madness. You can find that on YouTube. There's also a Twitter handle, Milkshakes Pod, that you can find. My contact information can be found at santiagocapital.com. And, I do a number of these types of shows. So, if you just Google, you'll find a number of interviews.
All right. Well, we appreciate your time today and continued success to you, my friend.
Thanks for having me.
There's Brent Johnson. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advanced notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com.
Hi there, this is Danielle DiMartino Booth, author of Fed Up, an insider's take on why the Federal Reserve is bad for America, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show as the holiday season is upon us. You can do your holiday shopping with the Real Estate Guys. Our upcoming Create Your Future Goals Retreat would make an excellent holiday gift, as would the 22nd Annual Investors Summit at Sea. You get all the details about the Real Estate Guys events at realestateguysradio.com. Well, a little diversion from real estate to back up and talk about the U.S. dollar and where it fits in the world, but great stuff from Brent Johnson.
Yes, I took probably 5 pages of notes, in fact, full 5 pages of notes, and we could probably do a 2-hour session just on analyzing everything Brent had to say, which is fabulous. But I think if I were to boil it down to what really matters, some big takeaways, is something we've been talking about on Investor Money Club for quite a while, and that is there's a difference between a trend and an event. And I think sometimes people who are watching a long-term trend, like the collapse of the dollar, want to put a date on it and time the event. And I think what Brent is saying is that's a mistake. And I would agree with that. We've been hanging around financial conferences for a long time, and we've watched Peter Schiff and Mark Skousen go at it. And they're both brilliant guys. Peter has been saying, hey, the dollar is doomed. It's going to end up being the least desired currencies. Foreign currencies are a place to go. Obviously, Brent and Peter disagree.
Well, in fact, Brent and Peter have had several public debates on YouTube and other places, friendly debates, but they do see two different sides of the coin.
Yeah, and I think that that's great. I remember the first time we were exposed to that basic concept was at an interview at Freedom Fest with a guy named Steve Hochberg from Elliott Wave.
Right.
We were all worried coming out of the 2008 crisis, watching the Fed's balance sheet go from $800 billion to $4.5 trillion, all this money being printed, the TARP program, all of this stimulus. We thought for sure the dollar would collapse. And he goes, well, there's actually going to be deflation before there's inflation. And of course, real estate prices collapse, that's deflation. Stock prices collapse, that's deflation. And the dollar became very strong. It didn't take as many dollars to buy those types of things as a result. And then later on, we got back to inflation, which we all think of as appreciation in real estate. The other big takeaway from Brent was just the notion that, yes, over the long term, currencies are failing. And therefore, over the long term, what you would want to do, he said, which I agree with, is go into debt to hold assets long term. And of course, the best debt you can get is real estate. The best asset to get to be affected by inflation is real estate, both on the asset price and also on the income. And then you marry that to long-term fixed debt. Real estate is arguably the single best investment or the foundational investment of building what I call a real asset portfolio to take advantage of or be on the right side of this inevitable trend. We don't know when or if the U.S. dollar will eventually collapse or be supplanted by somebody else. We know there's big powers that are working very diligently to do it. They're setting aside many of their differences. Brent talked about how these countries don't really get along, but they all seem to want to get together to work on this one thing. So they've got to feel really bad about the system they're in, and the desire to de-dollarize is strong enough for them to overcome or set aside their differences in order to work together to do it. Now, whether they can or not, well, we're going to see.
Well, and that's a clue, the fact that there is that motivation, which is why we pay attention to this stuff. So if you've made it this far through the program and you're just a classic real estate investor, congratulations. You got to be thinking about this. I mean, we could get into the weeds on the whole euro dollar issue, but for now, just know that there is more U.S. dollar denominated debt outside the U.S. than the tremendous amount of debt inside the U.S. That will mess with your brain. How do you get around folks that are talking about this stuff? Well, the real estate guys go to lots of conferences, not just our own events, but other conferences, and you can find out where those are on the events page at our website. But the way we got to hang around with Brent is we invited him to our collective inner circle gathering, which is the most exclusive thing the real estate guys are involved with our good friends Jason Hartman, George Gammon, and Kenny McElroy. It's an amazing place to get around not only these kinds of thought leaders, but folks that are interested in discussing these topics.
I think anybody paying attention realizes that there are shelf lives for fiat currencies and economic systems. I think that anybody paying attention realizes we've had a few resets in the past, did a presentation on that in the summit a few years ago. And if you're paying attention, we're getting closer to an end game. Now, that doesn't mean the end of the world. Economies don't end. Economies are based on people having needs and people creating solutions for those needs. That will never change. As long as there's human beings, there's going to be hunger, need for shelter, clothing, energy. So if you are investing in those things that are real and essential, you just have to understand enough about the financial plumbing to be prepared for a transition. That's why Brent was talking about this idea of having gold in a portfolio. Pretty much everybody agrees that gold has a place in a portfolio. People agree in debt and investing in things that are real and essential. But it's time, if you haven't already started, to begin to really pay attention to these things, because things start to happen faster as you get closer. Or I think my friend Adam Taggart calls it the circling the drain. Yeah. It starts to circle the drain. When it gets to the end, the drain starts to circle faster. And that's what's going on. So this collective inner circle thing is amazing, where we got a chance to hang out with Brent in the Bahamas just not too long ago. George Gammon is this huge macro guy, really, really understands the financial plumbing and the relationship of the balance sheets and the euro dollar, and he studies all that and boils it all down. Of course, Kenny is the quintessential syndicator, big real estate investor. Jason Hartman, very successful single home investor and been very active. He thinks a lot the way we do about what's going on in the world. And of course, then they invited us to join, and we're like, yes, we'll do that. And so it's been an opportunity for us to open up our syndication inner circle and merge it into this other collective that they had, and we now call it the collective inner circle. And whereas for us it was something that we never talked about on the show, now it's more open, and so we can invite more people to be a part of it. If you think you'd be interested in doing that, we get together with these guys 4 times a year for 2 days at a time, and we have these deep conversations, invite in special guest speakers. We had Brent, Mike Maloney at the last one we just did. And we're really kicking off January 1st, but just send an email to collective@realestateguysradio.com, collective@realestateguysradio.com. We'll get you the information on it, and you'll be able to apply for membership if you're interested after January 1st.
Big thanks to Brent Johnson for sharing his time and his big brain with us today. It's the most wonderful time of the year as we wrap up 2023. Got a lot of great shows coming up. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.